Time to play a game. I will throw some bond types at you, and you can give me then what type of return individuals could earn from those types of bonds.
Yeah, I'm ready. Fun.
What can I earn from a 2-year Swedish government bond?
I would say just below 2% or something right now.
How about a 2-year investment grade corporate bond?
It has been quite a lot of volatility in credit spreads the last weeks due to the high uncertainty around the trade wars. But for a 2-year Swedish investment grade bond, I would say around 3%, depending on company.
How about a 5-year investment grade corporate bond? So we go a little bit longer in duration.
Yeah, so there I would say around 3.5% to 4%, depending on company. And currently we have a quite flat yield curve in Sweden, which means that you, at least in my opinion, aren't really compensated to invest in bonds with longer maturity. Longer maturity means higher risk, but in my opinion, not high enough yield right now.
Hello and welcome to the Investing in Other Stories podcast. I'm your host, Margarita Triantafiliou, a former Wall Street executive, CFA charter holder, and founder of Finance Latte, a leading investing education company. I founded this podcast to fill what I was missing in the finance industry, a place where top women investors can share insights directly with you, the individual investor, to empower you and inspire you to invest more and build wealth. It doesn't matter if you've been investing in stocks, funds, and startups for years. This podcast is for you. I'm so excited about today's episode because we welcome a corporate bond investor. What does that mean? It means that she manages a bond fund that you could find in broker dealers like Nordic or elsewhere. And we will get a sneak peek into her role and how she makes investment decisions, including some not so vanilla trades that you might expect in a bond fund. With me today is Madeleine Almqvist. Madeleine is a portfolio manager at Case Fonder with a mandate to invest in the Nordic corporate bond market. She holds a master's degree in accounting, valuation, and financial management from Stockholm School of Economics. Prior to joining Case Fonder, Madeleine worked as an analyst at Handelsbanken Corporate Finance, and she also has experience from the trading floor at Nordea Markets in Stockholm. Madeleine, I'm so glad you're here, and a warm welcome to our podcast.
Thank you so much for inviting me. It's so fun to be here.
I cannot wait to get started. So you started in the investment banking industry and were on the trading floor before moving into asset management. Can you contrast these experiences for us, especially for our listeners who are outside the finance industry?
Yeah, so I would say that the dynamic and the day-to-day work differ quite a lot between the different departments of a bank. So within the investment banking industry, most of the work is project-based around a specific transaction. And that could, for instance, be an M&A deal or an IPO transaction. M&A deals are mergers and acquisitions, and IPO is when you're taking a company from a private setting to a public listing at the stock exchange. I would say you can expect a high workload and interesting analysis where you get the chance to dig really deep into a specific company. At the trading floor, you will experience a high tempo and a lot of things happening during the day, and your tasks will depend on which trading desk you belong to. But my overall impression is that you have a broader exposure to different companies and work more in one team with several deals and transactions rather than project-based. So in that sense, you're exposed to more broad analysis rather than very deep analysis into a specific case.
And where did you trade?
I work at the credit sales desk at the Nordea Markets and assisted the salesman there with different type of tasks.
For bonds, essentially.
Yeah, exactly. Corporate bonds, yeah.
Great. Then you moved to Case Fonder, which is pure asset management. Was there a specific moment in time that made you think, oh, I really want to be on the so-called buy side, which is asset management?
I think to me, it was a great and very valuable experience to get the chance to experience both investment banking side as well as the trading floor. But after a while, I felt that it would be an interesting next step to also try the buy side, and then to do my own analysis and to take more long-term decision based on that analysis, and also to build a portfolio and to follow up the performance. At that point in time, I heard about my current employer, Case Asset Management, and it was just a perfect match. Today, I work as a portfolio manager at Case, and together with my colleagues, we manage several funds with mandates to invest in the Nordic corporate bond market.
Wonderful. And the one thing I will highlight for me is like you mentioned before how your prior experiences were more transactional versus here that you invest more long term. And I think that's really the key. If you had to distinguish by two qualities, I think these two really sum it up on what's different on the buy side. You invest for the long term on behalf of clients.
Yes, exactly.
So you are a portfolio manager. Can you tell us what a typical day looks?
So, for a typical day, I read a lot about economic and political news and activities around the world, which in turn then have implications for the macro environment and the interest rate levels and also the market risk appetite. I also read a lot about more company specific information, such as trading updates and press releases, and also use that as a part of my analysis. So you can say that the performance of corporate bonds is dependent on both the overall macro and interest rate development, as well as the more company specific performance then.
And I think that's a big difference with stock portfolio managers where they don't necessarily look at the macro as much. They really focus on the companies versus a bond investor like yourself who you need to know the macro picture, right?
Yeah, exactly. And that's why corporate bonds is so interesting to me at least. I can also mention another day-to-day task, and that is to handle the liquidity of the fund, and that is then the inflow and outflow of money. So then I have to buy and sell assets or to reallocate between different bonds. And we invest both in the primary bond market as well as buy and sell bonds in the secondary market. So the primary bond market is when an issuer goes to the market to issue a new bond and then to raise new money. And as a preparation for those deals, we get the chance to listen and talk to management, who then will present the business of the company. After a primary transaction, we can then buy and sell the issued bonds on the secondary market. And this means that the bond changes hands via the secondary market without that new money being raised for the issuer. Yeah, you can say that I act both as a portfolio manager, but also as an analyst in my day-to-day work.
Wonderful. So you already gave us a hint that interest rates affect bonds. Can we go into that a little bit more and explain that real inverse relationship between bond prices and interest rates or yields? Can you describe that? Because I think it's such a key element of bonds that people should really have it crystal clear in their head.
Yeah, of course. Just as you mentioned, interest rates and bond prices have an inverse relationship. So it means that when interest rates increase, the bond prices decrease and vice versa. So when the bond price has decreased, the expected yield for that bond is higher. And yield is then another word for expected return. You can say in general, a new bond is issued at par, which means 100% of the nominal value. And we also call this value par value or face value. And over time, the bond may then trade at a price below or above the nominal value. It depends on the movements in interest rates as well as the risk appetite of the market. So the lower the price, the higher the expected yield or the expected return, more or less. Does it make sense?
It does. So it doesn't mean that if we see an amazing 20% yield, oh, we should go buy it because that's what we're going to get. The risk moves up as
Exactly.
the yield
It's a
goes up,
reason
right?
to the higher yield. Yeah. Yeah.
Exactly. So we should not go buy Turkish bonds then that have incredible yields at the moment.
No, it depends on your risk profile.
Exactly. Because I think they had something like 50%,
Yeah.
50.
High inflation, high interest rates.
Exactly. Let's add one more layer to this conversation. Can you give us an example of the credit analysis you have completed from start to finish before you bought a particular bond? Help us understand how you found the company, what analysis you did, etc.
Yeah, one source for us to find companies is when they approach the market in a conjunction with a primary transaction. And we are then approached by banks who assist the issuer with the transaction. We can also find bonds via the secondary market and are also there approached by banks who are active in the market. And a third source could be to find bonds via different types of databases. When evaluating a bond, I look at certain characteristics, both when it comes to the bond terms, but also more company-specific information. If we start with the bond terms, I would investigate the tenor of the bond, and that is since it will affect both the risk and the price of the bond. I will also investigate if it's a fixed or a floating rate for the coupon of the bond. And if you have a fixed rate, it implies a higher interest rate risk. I will also look at the currency, and that affects the liquidity and pricing of a bond. So if you have a US dollar or a euro bond, it tends to be more liquid compared to the Nordic currencies, for instance. I will also look at the size of the bond, also affecting the liquidity. And last but not least, the covenants. A covenant is then a clause in the bond term, which the issuer then agrees to follow. So it is a way to limit the risk that the issuer will default or also protect the bond investor. To give you an example, it could be that the issuer commits to a maximum level of debt, for instance, or it could be maximum dividend to equity holders or things like that. And if we then switch to the more company-specific aspects, I will look at the sector of the company, the geographic exposure, the ownership. So if it's a public or a private company and what type of owners we see. I will also look at the size of the company, competition, margins, cash flow generation, leverage, and also the balance sheet. And the balance sheet is quite important when it comes to bonds, since it's a way to evaluate the potential value that you can extract in terms of a default. So if we take, for instance, a real estate company, you have mainly tangible assets on the balance sheet, which then is preferred in case of default. If you have a consultancy business, you have mainly intangible assets, and that is much harder to extract value from in case of a default. Do you following the reasoning?
I am. So essentially, you're looking at the characteristics of the bond to understand all the type of risks, whether it's long duration, like a multi-year bond or not, if it's liquid enough, or what sector is in, and then you go to the company specific. And essentially, you look at what will happen if the company goes bankrupt. Will I be able to get my money back? The credit analysis. Did I sum it up more or less right?
Exactly. So what is the worst case scenario if everything goes wrong?
Exactly. Stock investors like myself like to think, what's the best case scenario?
Exactly.
What's our upside? How fast can this company grow? How big can it get? Bond investors look at things a little bit more differently.
Yeah, so bond investors are famous for being pessimistic rather than optimistic, I would say.
Exactly. Absolutely. We are perennial optimists on the stock side.
Exactly.
Great. So then can you help us categorize bonds from less risky to more risky?
So if we start with the one important risk for corporate bonds, and that is credit risk, and that is the risk that the borrower fails to repay the loan or to pay the interest. So in other words, the risk of default. And as an investor in corporate bonds, we add a credit spread on top of the base rate as a compensation for the risk we take to lending money to a specific company.
I didn't get that. Coffee break.
Yeah.
What does that mean?
So you can say the higher the credit risk, the higher the credit spread the company will have to pay as a part of the total interest cost.
They need to pay you more money to take that risk.
Exactly. So just to give you an example, if you invest in a government bond, for instance, then you lend money to a government and the credit risk is considered quite low for a government in general, while the credit risk for a corporate bond is considered to be higher since the risk is higher.
So credit risk is one way to classify bonds.
Yeah, exactly.
And there are also credit ratings, right? That are publicly shown for many of the bonds.
Yeah, that's completely right. So we used to divide companies into two different groups dependent on the credit risk. So one group is investment grade companies, and that means companies with a higher credit quality. And then we have high yield companies with a lower credit quality. And you also can call these bonds junk bonds. Maybe I've heard about that.
Yeah. Not a pretty name, but it describes them well.
Yeah. And there are official rating agencies, just as you mentioned, such as Standard & Poor, for instance. We have Moody's, Fitch, and they rate the credit quality of the companies and provide them with an official credit rating. So we have either investment grade ratings or high yield ratings then.
So they help investors assess the credit quality, but of course you do your own analysis. You don't just rely on those ratings.
No, exactly. So it's another complement to the overall analysis, I would say.
Great.
And then we can also add other common risk measures that is good to bear in mind. So the first one is credit duration or spread duration, and it measures how sensitive the bond's price is to changes in credit spreads. And that is then the risk appetite of the market, more or less. So if you have a high spread duration, it means a higher credit risk and that the bond price is more sensitive to changes in risk appetite. So good to bear that in mind. And then we have another risk measure, modified duration, and that is the risk that measures the price sensitivity of a bond to changes in interest rates. So here, a high duration means long fixed interest period, and that is higher interest rate risk. And the bond is then more sensitive to movements in interest rates.
If I remember my CFA materials quite well, I think if a duration of a bond is 5 and interest rates go up by 1%, bond prices are expected to fall by about 5%. So you see the negative impact of a 1% increase in rates. Is that more or less right? Do I remember it correctly?
Yeah, in general, that is correct. Absolutely. Summarize it like if you would like to decrease the risk in a portfolio, you should aim for low spread duration and low modified duration to make it simple. Yeah,
exactly. So don't pick a 30-year bond, pick a much shorter term
exactly.
bond, essentially.
Yeah,
okay. Wonderful. I'm getting brownie points here, guys, alongside with you on bonds. This is not my masterclass. So time to play a quick game. I will throw some bond types at you. And maybe you can give me some yield ranges, as in what type of return individuals could earn from those types of bonds. And of course, this is at this point in time on this recording, as of end of April, things change rapidly these days. So we'll do our best to generalize. Are you ready?
Yeah, I'm ready. Fun.
All right. What can I earn from a 2-year Swedish government bond?
I would say just below 2% or something right now.
Okay. More or less. How about a 2-year investment grade corporate bond?
Yeah, so it has been quite a lot of volatility in credit spreads the last weeks, and that is due to the high uncertainty around Donald Trump, tariffs, and trade wars, and so forth. But for a 2-year Swedish investment grade bond, I would say around 3%, depending on company.
So a little bit more than the government. And how about 2-year junk bonds?
The volatility has been even more evident for junk bonds than for investment grade spreads during the last weeks. But right now, you can probably expect between 5 to 10% yield for a Swedish junk bond. But that is then very much depending on the company.
Exactly. A wide range because it's a very broad universe.
Yeah, exactly.
How about a 5-year investment grade corporate bond? So we go a little bit longer in duration.
Yeah, so there I would say around 3.5 to 4%, depending on company. And currently, we have a quite flat yield curve in Sweden, which means that you, at least in my opinion, aren't really compensated to invest in bonds with longer maturity. Longer maturity means higher risk, but in my opinion, not high enough yield right now.
Interesting. And how about even longer than 10-year investment grade bonds?
I would say that in the Swedish corporate bond market, it is quite uncommon actually, with the maturity above 5 or 7 years. And I assume that it has to do with a lower demand for longer maturities from investors, or maybe that companies don't want to pay for the extra compensation that investors would require to invest in longer maturities.
Okay, so they have to keep rolling over their bonds in the market.
Yeah.
With shorter
That's
time
correct.
frames. Interesting. That's a little bit different than the US market, where companies are not afraid to go over 10 years.
It tends to be longer in maturity in Europe as well, but the Nordics are a bit different.
Interesting. It reminds me of my mortgage, actually. That is, we fixed a portion of it, but then part of it is floating, and that's what most mortgages are in Sweden.
It's
very
also
unlike.
very different around the world, how long maturity you used to have on the interest rate fixing period.
Exactly. All right. Okay, another question. A lot of investors have this misconception that bonds are boring. And I say that with a straight face to a bond investor. But I read one of your recent articles, and there was something really fascinating, actually. It mentioned the trade that you made where you bought a bond and paid 60 ore for 1 kroner. Can you walk us through that type of trade and the math behind it? Because I think some investors, including myself initially, might not get it. So walk us through that math.
Yeah, so I can agree that bonds can sound a bit boring and complicated, as I think that you also discuss with Tina in a prior podcast episode.
Exactly.
But the bond space can actually also offer great opportunities and have potential to deliver attractive returns. The case you referred to here was born out of the tough years we had about 2 years ago after the pandemic. And then inflation increased very fast, and several central banks were forced to increase policy rates as a way to tackle high inflation. And this in turn created a very tough environment for several of the Nordic real estate companies, which of course were affected by the higher interest rates. Some of these companies were in deep problems with too high leverage and high high exposure to floating interest rates and tight liquidity. And as a consequence, then the investors started to worry about refinancing of their bond maturities for those companies. And the bonds therefore traded at very low prices or at high discount. Me and my team, we did a comprehensive analysis and found some bonds with potential to deliver very good returns. And in our view, we saw one way for those companies to solve their problems. And that was get acceptance from bond investors to actually buy back bonds at a discount. So if we can buy 1 krona for 60 öre, and the company can close 1 krona of debt for 80 öre, for instance, that is a win-win both for us and for the company. So we managed to find a couple of cases like that, which then turned out to be very successful.
Wonderful. And did you approach your analysis differently than your normal type of bonds that you would buy, given that it was a much riskier investment?
Yeah, so I would say a very important thing in those types of trades will be to have a view of the worst case scenario. So what you are risk on the downside and put that in relation to potential upsides here. So you can say, in other words, to find cases with very attractive risk reward. So you'll have to make a deep analysis, think about potential liquidity for the case and for the company, and what forces will push the company to actually act in a specific way, and also calculate the potential outcome in different type of scenarios. In a normal case, it is very important for us to be comfortable with the sector, the business model, financial performance, etc. But in those special situations, then more short-term trade be attractive, and even if we don't really like the company as such or the metrics more in the long run. So I would say it's a big different analysis in those cases.
I want to put this kind of in context of risk appetite. So sometimes I speak to a lot of women who sometimes have a hard time being able to take the risk. Sometimes even women are labeled as risk averse. For me, I like to say it's just understanding the risk. That's different than being risk averse. And from what I'm hearing, you understood the downside risk, the worst case risk, and you put it in perspective to your upside. And that's how you can be comfortable with that decision, that you understand the downside, you're aware of it, but you also look at it in respect to the upside. Does that sound remotely correct?
Yeah, that's a good summary. And also to not put all the money in the same company, that you actually diversify between different risks. So a good big picture.
Exactly. Great. So we've been talking a lot about Nordic bonds. And do you have an outlook for the Nordic fixed income market for 2025? As you mentioned already, there's a lot of volatility, a lot of kind of chaotic policies coming out of the US that is affecting, has rollover effects in Europe as well. How are you positioned in terms of risk?
I guess that most people can agree around that with Donald Trump in the White House, uncertainty has increased a lot. And that is for most markets and the different areas also in society. And this is, of course, also true for the Nordic corporate bond market. And I think that we can expect quite a lot of volatility during 2025. And it's very hard to take a position for any specific outcome, since Mr. Trump can change ideas very fast. So for us to handle this uncertainty, we are positioned with a short modified duration in our funds. And it means then that our funds are less sensitive to movements in interest rates. That is since we can identify several drivers, both for higher and for lower interest rates going forward. So if you see like a potential recession in the US and in the rest of the world, that is a driver for lower interest rates. But on the other hand, if you see risks for higher inflation due to trade war and massive tariffs, then that is a driver for higher interest rates. And another perspective is that we also prefer bonds with short maturity. And that is since these bonds tend to be less price sensitive in a volatile market. In addition to that, a bond maturity will also generate new cash for you as an investor, which you then can invest according to the current market conditions and then have the possibility to make really good investments at that point in time.
So it gives you more optionality to make a bet later down the road.
Yeah, exactly.
Great. And how have tariffs affected the European and Nordic bonds? Because we know from the US side that yields have shot up and higher yields do have kind of a rollover effect across the pond as well. So what's happening right now in Europe and in the Nordics?
Yeah, I would say in the beginning of the year, we mainly saw movements on the stock markets, but after a while, we also saw higher yields in the European corporate bond markets as well. And now, actually, in the last few weeks, we have also experienced higher yields in the Nordic corporate bond market. And I would say that as of today, it's very hard to say what this will mean for different types of sectors in the end. But maybe the most apparent effect right now is probably for the automotive sector, which was directly affected by tariffs on top of the already challenging conditions. And especially here in Europe, with competition from China, you have major transition for the whole sector to more electric vehicles as well. A lot of challenges there.
So it's particular industries that are getting impacted more than others.
It will probably, yeah, we don't know about the future, of course, but as of today, the most clear impact is probably automotive sector.
And can you give us a broader high-level view of the composition of the Nordic bond market? Is it dominated by banks or one or two countries? What does it look like?
The Nordic corporate bond market is a quite young market, but has experienced substantial development during the last years. In Sweden, about 50% of the bond market consists of real estate bonds. And we also see a lot of financial companies in Sweden as well. So banks and insurance companies, for instance. And in Norway, you will see more of oil and fish related issuers. If you then compare the Nordic corporate bond market with the European market, the Nordic market is less liquid, especially than in the Nordic currencies. But you will also see, on average, a slightly higher yields as a compensation then for the more liquid market. So that is a broad overall picture of the Nordic corporate bond market, I would say.
That's very interesting. Yeah, thank you for sharing. I did not know many of these characteristics. So it's always helpful to know. And of course, it makes sense given that we have our own unique currencies per country. By default,
Yeah.
that would make them less liquid than the ones denominated in euros that are easier to trade.
Exactly.
I want to ask you about AI really quickly. Is AI disrupting your job as an investor and asset management in general? Do you think your job is going to change significantly in the next few years?
I can see that AI is coming more and more, and I'm sure that investors approach the concept quite differently. I would maybe assume that we will see more major effects in the equity market first, since it's a more liquid market with a lot more accessible data. My approach is at least to learn more about AI in order to better understand the potential of use cases, but also the potential risks. And then we will see what the future has to give us.
Great. So you're embracing it and learning more about it.
Yeah, I think knowledge is the best way to tackle it, actually.
Great, great. So for our listeners who are individual investors and invest in bond funds, what would be your key 3 tips for successful investments in bonds in general?
I would say first to have a clear view of your investment horizon and take risks in line with that horizon. So the longer investment horizon, the more risk you're able to take. And then secondly, I think you should take a look at the exposure of the fund that you're interested in to see what type of sectors and geographies that are included. Are they investment grade companies or more high yield companies? And how does the exposure of the fund actually match with your other investments in your portfolio if this fund adds concentration or diversification to your portfolio. And then third, you should take a look at the duration of the fund. If you remember, the lower duration, the less price sensitivity and the lower the risk.
So essentially understand the characteristics of the fund.
Yeah, that is a good idea.
Exactly. And I love how you said take a look at the geographic exposure. A lot of times individual investors look at funds as a black box, as a product, but it really is a basket of things and we should understand what is in the fund. That's like the best way to understand it. Yeah.
Yeah.
Exactly. Great. So you are, of course, a woman portfolio manager. And I was looking at the statistics just yesterday. There's only 16% of all portfolio managers in the world that are women. So we have a lot of room to bring more women in asset management. I wanted to ask you as to how do you think we can bring more women on the buy side in asset management? We have had a lot of push to get women into banking, investment banking, but less so specifically in asset management. So how do we tackle that problem?
I think it's important to start early with information about investments at large. We know that we have inequality when it comes to savings. If you zoom in at gender inequality specifically, women have less exposure to investments in financial markets compared to men, which in turn then increases the economic differences in the long run. So I think if you can inform and educate more about savings and investments during younger years in school, I believe that it also will be easier to attract more great women to the asset management industry as well.
So encourage them to get involved early on with investments themselves.
Yeah, and to understand and learn more.
Great. That's part of why we're here. So hopefully
Yeah.
we accomplish that.
This is a great initiative.
But yeah, everybody I talk to, every guest I've had so far, it's all clear that you are all passionate about your jobs, your positions. They're really intellectually stimulating. You enhance your worldview. These are like great jobs. So I just wish more women knew about them.
Yeah, that's totally correct.
Lastly, I wanted to ask you about if you have a personal motto or guiding principle that you live by that has helped you both in investing and in general in your broader life.
I used to think that nothing is impossible. Some things require a lot of work to actually happen, but I just don't like to get stuck in a mindset where things are impossible. That's why I used to have that guiding principle that nothing is impossible. In addition to that, I also try to remember to be grateful. We have so much to be grateful for, and it can also help a lot to find a positive mindset, especially in recent times when we read a lot about developments around the world.
Wonderful. That keeps you grounded.
Yeah, exactly. And positive. And that's useful as well.
Positive. And for the young investors who are listening in who think that bonds are just for retired people, what would you respond to that misconception?
I would say that what type of products that are best suited for your portfolio, it depends on your investment horizon. So if you are a young investor and save for your retirement, then you should probably take more risk and have high exposure to the equity markets. But if you have savings that you will need in the more near term, maybe within a few years or so, then bonds could be a good alternative. And then it's quite uncommon to invest in bonds directly as a retail customer, since the minimum investments tend to be quite high. So it's hard to reach a good diversification as a retail investor. But there are many corporate bond funds out there offering exposure to different types of bond markets, but also different risk profiles.
So people can look and find the one that fits what they're trying to achieve, essentially.
Yeah.
Wonderful. I think a lot of people will be inspired to check out bonds after this conversation because they will understand the risk profile and the nuances that the bonds bring. So thank you so much, Madeleine, for joining us on the podcast and for your wonderful insights into bonds.
Thank you so much for having me.
And thank you all for listening to the Investing in Other Stories podcast. If you enjoyed this content, please take a moment to subscribe to and rate the podcast on Apple, Spotify, or wherever you get your podcasts. You can follow me, Margarita Triantafilido, on LinkedIn or at Finance Latte on Instagram, and Madeleine Almqvist on LinkedIn. Cheers and see you next time. The information provided on this podcast is for informational purposes only and should not be considered investment advice. The opinions expressed on this podcast are as of the day of the recording and are subject to change without notice. The views and opinions of guests on this podcast are not necessarily those of Finance Latte AB or its host Margarita Triantafilido, collectively referred to as Finance Latte. Finance Latte is not affiliated with its guests or their affiliates unless otherwise stated. Finance Latte does not guarantee the accuracy or the completeness of the data presented herein. The information on this podcast is for informational purposes only, and the information, data, analysis, and opinions it includes should not be considered investment advice or tax advice, and is therefore not an offer to buy or sell a security. Finance Latte AB is not responsible for damages or other losses resulting from or related to the information, data, analysis, or opinions in the recording. Past performance does not guarantee future results. All investments are subject to investment risk, including loss of principal. Individuals should consider their own unique needs and circumstances and objectives before making investment decisions. Please consult with a tax or financial advisor for advice specific to your individual circumstances.